Good evening, ladies and gentlemen, and I would like to warmly welcome you on behalf of NDB Wealth Limited for the webinar on the recent tax amendments. We intend to bring some clarity onto the many changes that has been made by the policymakers in the past few months. And today I have to bring in this clarity to us. We have Mr. Rajitha Rodrigo, the Managing Director of WR Rodrigo and Company, Chartered Accountants. Good evening, Mr. Rodrigo. Thank you very much for joining us today. So I think Mr. Rodrigo will go through some of the slides initially about the past taxes, what we were paying, and then with the new changes that have come forward, how the tax treatment is going to be for our income, and this will be from an investment perspective plus on a personal taxation perspective again. So, Mr. Rodrigo, without any further ado and any delay, I'll hand it to you for your presentation.
Thank you very much. Good evening to you all. I'm Rajitha Rodrigo from WR Rodrigo Company, Chartered Accountants. First of all, I'll give you a sort of a background who we are. We have a chartered accountants firm that we have been in the practice nearly 35 years, and we are serving more than 1,000 clients in Sri Lanka from sole proprietor partnership companies and also public companies and with the high net worth individuals. And we are based in our head office in Colombo, and we have a branch in Colombo as well. And today I would like to initially thank to all the management of the NDB Wealth Management to provide this opportunity to share the knowledge on recent tax amendments which happened to the Inland Revenue Act from the 1st of January 2020. And we will discuss today how it's going to be affected to your personal income tax and any other, as Ranuga rightly said, how we are going to look at in the investor point of view and also personal tax point of view. So I think everybody can see the presentation on live. So if we go ahead with the recent tax amendments, we are going to discuss about everybody knows about now these advanced personal tax, APIT, and advanced income tax. So before we go ahead to understand what is actually the changes really occurred from the 1st of January 2020, we need to have a sort of understanding of what sort of revenue sources we do have personally, and also what kind of a tax structure we used to have before the 1st of January 2020. So can you help me out? Thank you. So if you go ahead with what are your revenue sources? Okay, basically if you go into your revenue sources, it's employment income. You can be having dividend income, interest income, rent income, consultancy income, and also business income. So altogether, if you have any of these income, then you actually need to look into that whether you are really need to eligible or liable for any tax liability. So again, employment, dividend, interest, rent, consultancy, and business income. Okay. So we come up to the income tax rate, which were prior to the 1st of January 2020. I think if you are already a tax payer to IRD, I think you must be known with your help of your tax consultant what were your income tax rate before the 1st of January 2020. So earlier, before these amendments, we used to have income tax rate of individual maximum of 24%, and also we got a relief up to 1.2 million, which actually they segregate them on employment tax relief, which is 700,000, and personal income tax relief, which is 500,000. So any person who had only employment income, he or she actually were able to claim only up to 700,000. But if that person were having any other income apart from the employment income, for example, if he had any interest income, dividend income, or rent income, likewise, they were able to claim additional 500,000, which altogether you were enjoying around 1.2 million as your tax relief. So after the reduction of the tax relief, if there is any taxable income, you were taxed on these tax brackets. As you can see in the presentation, for your first 600,000, it's 4%, and then 8%, 12, 16, 20, and whatever the balance, it was 24%, maximum of 24%. And also we will discuss with the illustration to get understanding. Okay, get understanding how it really it was when you really did a tax computation before the 1st of January 2020, or these changes came into the act. So we'll go move on to the next slide. So first illustration, just to get a sort of get an idea and how we actually did the computation previously. So Mr. A is a CFO for company Q. He received the following income during the year of assessment, and employment income is 4.3 million, and already deducted pay, the pay has been deducted from his salary, and that was the payment he has made. Interest income 1.6 million, dividend income 150,000, and the rent income is 450,000. So this is the illustration. This we'll see how it's going to work in our calculation. So earlier, actually the employment income is part of your assessable income. So because of that, we are taking into that calculation. And if you go to that investment income in this calculation, the interest income before the 1st of January 2020, we used to have actually, I think there were withholding tax of 5% were deducted by the bank from your interest, which you have deposited. And also for the dividend income, they have actually deducted 14% as withholding, and they have paid on behalf of you to the IRD. So earlier, these withholding taxes were final taxes. So if it is a final tax, it is not been a part of assessable income. So you can understand through this calculation that even though the employment income will be taken under assessable income, if you go to the total 4.8 million, they have taken only employment income and the rent income. So why they have not taken the interest income and dividend income? So that's the question, because it was the final tax. Before the 1st of January 2020, you were having withholding tax for interest income and also dividend income. So that withholding income is a final tax payment. So because of that, it was not taken under your assessable income, and it is were taken separately. So the assessable income is 4.8 million. You know that it's only employment income and the income. The point I want to take up over here is you need to understand previously interest income, dividend income, withholding was your final tax. The withholding was the final tax. It was not taken under assessable income. So if you go to the next slide, so you can understand, okay, the assessable income is 4.8 million, and since he had the employment relief, he can claim 700,000, and then rent relief is 112,500. I think everybody knows that. From the rent income, the department is given a relief of 25%. So that if you calculate 25% out of that rent income, that is 112,500. And also the personal relief is there because he has the other income apart from the employment income, that is rent income. Because of that, he has another personal relief around 500,000. So altogether, your deductible total tax relief is 1.3 million. So out of your total assessable income, the taxable income will be 3.5. So if you get a taxable income of 3.5 million, if you go through that tax table, previous tax table, your tax liability will come to 485,000. Out of that 485,000, you have to reduce the payee tax you already have paid to the department. So that is 129,600. Whatever the balance is, 350,000 is payable to the department. So this is how the calculation will happen previously, before the 1st of January 2020. Now it has been changed. So we will look into the changes which has happened after that. Okay, so when it comes to this tax revenue sources, okay, when it comes to employment income, prior, for the employment income, the government there were tax called pay as you earn. We call it pay. So pay was deducted from your salary, and then it has been remitted to the IRD, and the responsibility was with the employer. If the employer didn't deduct the pay from their salaries, the employer was liable to pay to the department. And what happened actually after 1st of January 2020? So government actually abolished the system of payee. Now from the January onwards, you do not have a tax called payee. There is no any payee scheme. They introduced a tax called advanced personal income tax, which we are going to discuss more further in the presentation slide, which is an option. So APIT is an option for them. They can give the consent to the employer, or otherwise they can open up their own income tax file and pay their taxes on quarterly basis. So there is a huge difference between them. Earlier it was pay, it was deducted. Now there is no pay anymore. They have introduced another tax called advanced personal income tax for that. Still, it is the option whether you can give it consent to your employer to deduct it, or otherwise you can open up your own income tax file and you can make the payments on quarterly basis. So interestingly, interest and dividend, which I explained you initially, it was actually the final for the individual. The whatever the interest 5% withholding and the dividend 14% withholding was when they deducted from your interest and dividend, it was your final tax and it was not part of assessable income. So what happened after 1st of January 2020? The government took all these withholding taxes from the act. There is no more withholding taxes. Now, how it's going to happen is, now this is not final. Now what will happen is interest and dividend will become your part of your assessable income. So you need to understand the difference over here. Earlier it was a final tax. It was not part of your assessable income. You did understand through the calculation. Now after 1st of January 2020, it is not final and it is your part. It is part of your assessable income. This is something you need to really understand. And if you have not understand, you have your Q&A session. In that session, you can ask whatever the question you want. And also when it comes to rent, yes, earlier it was part of your assessable income, now also part of assessable income, and the government was giving you 25% allowance for that, same applicable for the both periods. And also consultancy, if you have any consultancy income and if you have any business income, still it was part of your assessable income, still it part of your assessable income. The whatever the major changes were happening was related to employment income and interest and dividend. So I hope you want to understand. So we will move ahead with the presentation. So is pay abolished? Yes, as I explained you, from 1st of January 2020, from the notice dated 15 February 2020, it was abolished. So however, I think even it was abolished in 1st of January 2020, I think every employer were happy and they didn't actually pay the pay from the January, March and February and March. But all of a sudden from notice came during the month of April and the government again requested you all to pay the pay from the January to March. So but there is no pay. But however, for the convenience and the request of the employees, the tax deduction were accommodated under the previous pay system. So all the employees were given the consent to the employee in the month of April to deduct the taxes from January to March under the same pay system and then pay to the IRB. So we will explain you furthermore on this. So after that, so really what happened was, so even though the government abolished the pay from the 1st of January 2020, there were no any pay until March, but all of a sudden April they put a notice and they introduced another scheme we call APIT, Advanced Personal Income Tax. So we will understand about that. So what is APIT? APIT is Advanced Personal Income Tax. It's a scheme where the employees may request the employer to deduct the tax as sources on employment income. Here, you need to understand there are two options you can select under APIT. That is because, so now from the 1st of April 2020, you don't call pay, you're going to call APIT. APIT. So there are two options you can select. Either you can give the consent to your employer to deduct the tax under the APIT calculation guidelines and then remit to the IRB. But here, one thing you need to understand. Previously, under the pay scheme, the obligation were with the employer. Now, we do not call as payee. Now we call it as advanced personal income tax.
It's your personal income tax. Even though you choose the option 1, if the employer didn't deduct and pay to the department, still it is not the employer's obligation. Still, it will be your personal obligation. So you need to understand what, say, really, it's not actually the numbers or the system. Actually, it's totally the responsibility of the taxes has been moved on to you. So you need to be really very serious on this scenario. And the second option is, if you do not like to provide the consent to your employer, what you can do is you can open up your own income tax file, very easy, and then you can start paying direct payment to the IRD on quarterly basis. Here, I just want to give you the, so why they have given two options and what is the benefits. What is there any benefit of choosing option 1, option 2, or is there any benefit of choosing option 2 over option 1? Okay, fine. So here, once they issue this notice, if somebody choose option 1, the department already have given a calculation for the APIT. If somebody has chosen option 1, where they given the employer to deduct this tax, the employer use a tax calculation which you are given by the Department of Interior. But the thing is, I will explain you it further down in the presentation. From the 1st of January 2020, you are being given a new tax relief which is around 1.2 million, which is applicable for 5 expenses, and that 1.2 million has not been embedded to that calculation which is provided by the IRB. So what will happen is, actually, end of the year, if you really see, the employer has actually deducted taxes from your salary which is more than your real liability, because that 1.2 million tax relief has not been embedded to the calculation. So employee can't do anything, because if the employer IRD has given that guidelines, if they have to follow it, it means if you choose option 1, end of the day, end of the year, actually, if you really check, you are paying more than your liability. So if you select option 2, what will happen? Okay, if you select option 2, you are going to open up your income tax file, and also you are the person who are doing the calculation. When you are doing your calculation, or your tax consultant do your calculation, that person that can incorporate that 1.2 million tax relief into that calculation. It means you are getting that new tax relief. You will reduce the tax liability. So end of the day, if you choose the option 2, actually you are paying to the department equal to the real liability. So if you choose option 1, end of the year, what will happen is, you will see there is a refund which should be given to you. So problem is, the government or the IRD has informed they are not going to refund the refund, but they will allow you to carry forward. But if you are going to carry forward, it means, are you going to do the same mistake for the second year? No. So that's why you need to be very careful in terms of understanding the option 1 and option 2. I think as the consultants, we always recommending to go with the option 2, where you will only pay according to your liability. So we'll move ahead with the next slide. Okay. So one of the favorite questions everybody asks, actually, if I request employer to deduct tax from January to March 2020, or up to further even after April 2020, can I avoid an income tax return? Absolutely no. A return would have to be filed for the year of assessment 2019-20 or no before 30th November 2020. If somebody can ask, okay, I do have only employment income, I don't have any interest or dividend or any other income, I have only employment income. Still, do I have to submit the return? Yes, you have to. You have to get a TIN number, and you will get the return by post, and then you need to submit the return or no before 30th 2020, which is the return applicable for the year of assessment 2019-20. So if you don't have any idea in terms of what is the year of assessment, it's same as the financial year, which actually start from the 1st of April of the year and up till to 31st March of the following year. Okay, so we'll go ahead with the next slide. Okay, so then earlier we discussed, okay, about APIT, Advanced Personal Income Tax. Now there is in the same notice, they have introduced another tax called advance income tax. So what is this advance income tax? It's a scheme of fixed regular payment requested withholding agent to deduct taxes sources with effect on 1st of April 2020. So what are these regular payments? Fixed regular payments. Okay, this can be dividend, interest, discount charges, natural resource payment, rent, royalty, premium, or retirement payment received on behalf of service performed by such individual. So these are the fixed regular payments they have described under the notice. So, okay, if you really recall what I told you earlier, okay, you had previously payee, now you have APIT. So AIT means you previously had withholding tax, which was the final taxes can be. Now they have introduced advance income tax. So you need to understand APIT for payee, advance income tax for previously withholding tax. So now, so we will have to discuss on this because earlier it was your final tax. Now, even though it is now, it is an advance income tax. Even in the word it says it's advance, it's not final. So now it's not final. It's the advance payment you make to the department. So advance income tax, how it is going to happen? Okay, here this is a bit a complicated process, which we do not recommend you all to take that process where the IRD would ask you to go, where your withholding agents will be your banks or otherwise any other company which gives you the dividend, or any other one of your clients who providing you consultancy fees. So that particular person, bank or company or any client, would be your withholding agent. So when they're making a payment, just this is after 1st of April 2020. So when they're making the payment, you can ask them to reduce the withholding. We do not use the word withholding. We use AIT, advance income tax, and then remit to the department. So now the problem is, what is the rate? When we have the final tax withholding, it was specifically mentioned for certain. For interest is 5%, for dividend is 14%, and for personal income it's 5%. Okay, fine. Now the problem is not that. There is no any withholding. Now we have income tax. So income tax, what are the income tax rates? So if you really, I will show it in the next slides. So we do have 6%, 12%, and 19%. The problem is when you are giving, so we need to tell them which percentage you have to reduce. The problem is, do you can actually calculate the this taxable income and see in which bracket it's going to be for, whether it is in the 6% bracket, whether it is a 12% bracket or 18%. It will be difficult for you. So, and even from the withholding agent point of view, it will be an administrative disaster, especially for the banks. So how many clients they do have with the fixed deposit? So how many information or the tax rates they need to take individually from a tax client? So it will be a very difficult task even for the withholding tax agents to proceed. So what we do recommend is always better not to request from the withholding agent, but when you open up your income tax files, what you can do, you can embed it in your quarterly income tax computation, and you can do in your quarterly payment as well. So this is you need to understand what was there, what is there right now, and what kind of complications, and if you really, what will be the best option to go with, and in order to have your tax liability. Okay. So we go ahead to the next. Okay, so one of the other question is unit trust is tax free? No, it's not tax free. It's now part of your assessable income. It's taxable. It's actually is not a different tax system. It's just like because when you are investing on a unit trust, we need to look into the what is the underlying asset. The underlying asset, if it is still it is the money market instrument, just like fixed deposit or any other instrument. So your revenue will be in your interest income. So it will be your, so now the interest income is part of your assessable income. So that's how the unit trust works. So then there is no any tax-free clauses is applicable for unit trust, since the underlying assets will be also just if it is applicable for money market. So then it depends on the instrument. Then if it is your return is in interest, then it is your part of taxable income. Okay. Initially, during my discussion with regard to APIT, I was telling you all that if you select option 1, in that calculation, you are not getting the new relief of 1.2 million, which was introduced from the 1st of January 2020. So now, these are the 5 expenses which is applicable for that 1.2 million. So any individual has any health expenses related, even health expenses, and also including contribution to medical insurance and educational expenses for your such individual or for your children. And if you have any housing loan, the interest on that, and also if you have made a contribution made to the approved pension scheme, that contribution, and also if you have made expenditure to incurred for equity and security. If you had any of these expenses, and if you have the right source documents, then you can claim up to 1.2. It is a new tax relief. Okay. So earlier, we have a tax relief of, if I really recall the very beginning slide, that before the 1st of January 2020, you were having employment relief of 700,000 and personal relief of 500,000, which is altogether 1.2 million. Now, there is no any payee. Because of that, there is no any employment relief. There's only now personal relief. There is no employment relief after 1st of January. There's only personal relief. So even that personal relief, they have increased up to 3 million. So that's why we were telling that any employee having an income more than 250,000 rupees per month is liable for income tax, because if you really multiply 250,000 into 12 is 3 million. So if you have revenue more than 3 million, you have to pay tax. The best part is, okay, even they have increased that personal relief to 3 million, now they have adding up another 1.2 million related to any expenses out of these 5 expenses. If you have any expenses, you can claim up to another 1.2. So altogether, if you have those expenses, how much is your total tax relief? That is 3 million plus 1.2, that is 4.2 million. So now you have a 4.2 tax relief compared to the 1.2 million you had previously before the 1st of January 2020. So these are the expenses. I know a lot of clients have this lot of question on this nature of the expenses, because actually for honestly that the department, even though they have given these 5 expenses, they have not issued a guidelines related to the definition of these expenses. So I can really I can answer you any question related to these expenses during the Q&A session, and I think I can elaborate more on that. So health expenses actually related to any health expense you made in Sri Lanka, and any medical insurance, and so also this includes the medical insurance in foreign countries as well. And then education expenses is totally on local educational expenses. It can be your tuition class. If you can get an invoice, you need to have invoice. If you can get an invoice, yes, you can claim the tuition fees as well, and also the payment you made to the local government schools or any international schools as well. And if you have any housing loans, yes, interest can be paid. But there are instances where there are professionals who get in personal loans for lower interest rate, but they are using for the house, construction of a house. But if you can really prove that, you can claim that interest as well, but not vehicle loans, any vehicle leases. That is not applicable over here. And contribution made to the approved pension scheme, that is approved by the Commission General of India. A lot of companies have pension scheme, but it is required to be approved. It can be approved by the Labour Commissioner of Sri Lanka, or it should be approved by the Commission General of India. So it we always say approved pension scheme, even though you can be contributing to a lot of any other private pension scheme, but that particular private scheme, pension scheme, need to be approved by the Labour Commission or some Commission General of India Revenue. Actually the in the Income Tax Act, it's actually silent who actually have to approve the scheme, but if it has been approved by the Labour Commission or Commission General in the Revenue, you can take it as an approved pension scheme. And expenditure incurred on equity and security. So this is one of the favorite topics, and people who are asking different questions. What is the definition of equity? What is the definition of security? So here, if you really go through the section 198 in the Revenue Act, we have definition for financial instruments. So under the financial instrument, there is a debt obligation. There is a clause of the debt obligation. Under the debt obligation, they have mentioned any deposit, debentures, commercial papers. Likewise, they have mentioned a lot of instruments over there. So I think department has not given a proper guideline. What are which instruments need to be which instruments are allowed under this relief or not. But I think based on the government point of view, the government wants you all to use the cash in your fixed deposits and then use it to invest in the capital market in Sri Lanka, which increase the capital market in Sri Lanka as well at the moment. So we will move it, and for you to understand, for 2000, since this tax relief is applicable from 1st of January 2020. So then last quarter from January to March 2019-20, you are eligible for 300,000, and for the current year 2020-21, it's total amount of 1.2. Okay. So what are the total relief available for individual? For year of assessment 2019-20, it's actually for the 9 months we need to, for data basis, we need to get the figures, because out of 500,000 personal relief is 375,000. Out of the 700,000, if you are a employee, is 525,000 you can adapt up to. And for the balance 3 months, definitely you know the balance 3 months, the personal tax relief is 3 million. If you divide it by 4, it's 750,000 per quarter. And also you are eligible for a 1.2 million new qualifying payment, new tax relief. If you divide by 4, that is 300,000. And for the year of assessment, the total tax relief, as I explained you, that is 4.2 million. And these are the new income tax rates effects from 2020. That is personal income tax relief, as I told you, 3 million. Qualified payment, which is the new tax relief, 1.2 million. Then after deducting that payment, the first 3 million, the tax bracket has been increased from 600,000 to 3 million. For the first 3 million is 6%, the second 3 million is 12%, and for the balance is 18%. Earlier it was 24%, now it has reduced up to 18% maximum. Okay. While we are understanding the tax implications or tax amendments which happened from 1st of January, we need to understand the penalties with regard to failure to register, failure to file your returns, failure to pay, or if you have any negligence, or if you are evading taxes. And these are the penalties you need to keep in mind. It's actually, I'm not creating a fear factor over here, but you need to understand the reality behind complying with the income tax regulation of Sri Lanka. So if you really fail now, if you are evading taxes, now in the Income Tax Act, they have included the criminal offense as well under section 186. So if you fail to register, now even recently the department issued a notice that everybody is required to get a TIN number on or before 30th of June. If you have not done it, they are going to impose 50,000 as a penalty. That is in the act. And if you late in filing the tax returns, it means the rate of 5% of the tax, as explained here, plus 1% interest in each month. So owe 50,000 plus 10,000 for each month, subject to maximum of 400,000. So do you want to pay tax or you want to pay penalties? It's up to you. And also failure to pay all and part of the installments. It means 10 to 20% of the unpaid taxes, and also 1.5% interest per amount compounded monthly. So it covers in section 179. So if you have any negligence in fraudulent act, then 25% of the underpayment subject to other conditions as well. And if you really seriously, if the considered in this opinion that you are trying to evade taxes, and if you really have evaded taxes, with the consultation of the Attorney General, you will be charged with criminal offences for the maximum of 5 years of imprisonment. So these are the provision has been made. So when you are understanding, you have to understand the whole. And otherwise, if you really if you have not complied with the laws of the regulation of Sri Lanka, then these are the penalties that have already provided in the Income Tax Act. Okay, so now we got understanding on the tax amendments which happened. I believe everybody got an understanding. I was very clear on certain aspects and on tax amendments. And now we did a first illustration on the previous calculation. Now we'll do an illustration on after the amendments. I will show it. I will do the same calculation to the previous calculation and this after amendment calculation as well. So Mr. A is the CFO of company A. He received the following income during the year of assessment. We say employment income, interest income, dividend income, rent income, and he has incurred the expense of education of his children. Okay, so this is the tax computation. If you go through the prior tax structure, tax computation, employment income, anyway, it's part of the taxable income. But the problem is earlier we used to pay pay, now we are not paying pay, we need to pay advanced personal income tax. So before the 1st of January 2020, we had withholding taxes and it was final and it is not part of taxable income. Now, if you really see this calculation in the second column, after the 1st of January 2020 with tax amendments, what has happened to the interest income? Now it has been considered as your part of your taxable income. And also if you see the dividend income, it has also considered as part of taxable income. And also as usual, rent income will follow as well. So if you really see, prior to 1st of January 2020, your taxable income is 4.8 million, and after 1st of January, according to your new tax amendments, your taxable income has went up to 10 million. Mainly due to that, the government has really abolished that withholding tax on interest and dividend. So if you go to the second slide, okay, this is how it's going to they are going to tax you. Okay, so taxable income, as you said, 4 million, 10 million is there. If you really deduct, and in the first period you had employment relief. Now in the second period we don't have employment relief. We had a rent relief as well. Same thing we are applicable for new system as well. And we didn't have any expenditure relief. Expenditure relief is new tax relief, that 1.2 million. It is not applicable for before the 1st of January. Now it is applicable because the 500,000 is education expenses. You need to have the invoices related to that expenses. And then personal relief, it was 500,000. Now it's 3 million. So altogether there is a tax relief of 4.6 million. So out of 4.6 million, sorry, out of the 10 million, if you really reduce your total taxable income, previously it was 3.5, now 6.9. So if you really do the calculation under the previous calculation, it's actually the total tax liability will come around 485,400. But if you go with the new tax changes, your tax amount has been increased 715,000. So you can understand what is the reason behind why the government has taken off the final tax of withholding 5% or 14%, and they wanted you all to pay to take those interest and dividend income as your part of your taxable income, and it will increase taxable income and increase the tax revenue as well. Because the logic was behind that, even the person who makes a 1 million interest is paying 5%, and the person who makes 100 million as interest income also pays 5%. So they want to remove that situation, and then every income needs to be calculated under the assessable income. So now you can understand how the tax impact on your revenue. So under the new system, you are going to pay more taxes. If you are going to ask, am I going to pay more taxes? Yes, I have to say yes. So that is the reality of the new recent tax amendments. If you have, so tricky point is, if you have more interest income and dividend income, any other income, you are exposed to more income tax. That will happen in the future. So the illustration third is just to make you understand, if the person has only employment income, and if he choose under the APIT, if he choose the option 1 and option 2, what will be the benefit of selecting option 2? As I explained you that during my slide, I will show that. I promise you all to show sort of calculation. This is the calculation. If that person has only employment income and he has selected option 1 or 2, what will be the best option he has to make? So I will do a calculation and show it to you. Okay, then. So this is actually with qualifying payment, without qualifying payment. With qualified payment is if you select option 2. Without qualified payment is if you choose option 1. So employment income is 4.2, as you understand, and then you have expenditure relief, that is under 1.2 million. I was telling you all, if you select option 1, in that calculation, the department has not embedded the 1.2. That's why in your without qualified payment under option 1, the qualifying payment or expenditure relief has not been given. So if you select option 2, we are going to open up your own income tax file and pay your taxes on quarterly basis, which is the with qualifying payment column. That you can see, you can include that 750,000 the expenses you have made. So you can understand the taxable income. If your employer calculate your taxable income, it's 1.2 million. If you really calculate your taxable income on quarterly basis, it is going to be 450,000. So end of the day, if your employer is going to reduce the tax from APIT from your salary, it's going to be 72,000. But if you're going to calculate the tax by your own on quarterly basis, it's going to be 27,000. So you can understand the difference. That difference actually is going to be a refund. If you're going to select option 1, it means you're paying more than the liability. You are not given the privilege of using that qualifying payment under employer's calculation. So if you let in the employer to reduce that tax, it means they are paying more than your liability. So end of the day, even though you have only employment income, as I told you earlier, you have to open up income tax return and submit the return on or before 30th. So in that return, there will be a refund. That refund will not be refunded next year as per the IRD at the moment. Going to be carried forward. So thank you very much to everybody. This is the total scenario behind the tax changes related to Income Tax Revenue Act 2017, and which happened after 1st of January 2020. So now I'm really happy to take up your questions to answer, and I will elaborate more on that if you didn't follow up me on the presentation. So thank you very much. It's up to Ranuka. Take it forward.
Thank you, Mr. Rodrigo. That was very informative, definitely, and I hope our viewers and our clients got a very good understanding of the tax implication. I think that brought a lot of light. Mr. Rodrigo, I just want to touch on something much a little bit more closer to heart, I would say, with NDB Wealth. So prior to that, so what you, in a nutshell, the policymakers or the Indian Revenue, what they have done right now is a policy that will include a lot more people on the tax net, and with so you are encouraged to open a tax file. Am I right?
Yes.
Right. And so, with that said, even though the benefits given, rather than going with a similar structure as payee, would be not beneficial, because again that will be to capture people on the net, and that's the benefit for opening a file.
Yes.
So, Mr. Rodrigo, then moving on, I said something closer to heart would be the NDB Wealth portfolio. So we have a gamut of clients. So we have 8 series of funds, which include, as you mentioned before, your money market funds, your government security funds, and your growth and income funds, which are balanced funds. So, Mr. Rodrigo, it was very clear initially the money market would be used simply as like your FDMI. Right. So, but if it comes to your growth funds, which has an equity component, how do you classify that in your?
When it comes to equity component, definitely you will be investing on the stock exchange. So whatever you invest in the Colombo Stock Exchange and the capital gain out of the selling of this quoted shares actually is from tax exempt.
Right. So, Mr. Rodrigo, when it comes to one of our funds, for example, the benefit is given to all the investors inside. So they have something called a realized and unrealized gain when it comes to their portfolio return in their equity component. So when it comes to a specific of a unit trust, in that case, is there any directive given as yet?
For the unit trust, they have not given us specific guidelines as such, but we'll have to look into the underlying assets of those unit trusts. So as we specifically mentioned in that money plus market, if you are investing in a unit trust in a which underlying asset in the money plus, then you will be specifically majority of your funds will be invested in fixed deposit, any other sort of instruments, similar instruments by the commercial banks. So that the return will be the interest income, because nobody can't take it. Okay, since the unit is given a valuation, it means that valuation is you are compounding actually interest income on daily basis. It's not actually a market valuation given it, but that you can't take it as a business. You can't segregate between business income or investment income when you are thinking about capital gains. It is not I'm coming under that category. We need to look into the underlying asset. And if the underlying asset is your fixed income, just like and the return is interest income, you need to take that as the interest income. So I think it's your responsibility to give that end of the year sort of a statement to your clients that during the period this is the interest income you have earned, and after that you need to disclose in their personal income tax returns.
Moving on the same lines, if we talk about an instrument, or let's take a fixed deposit per se, what if it's a fixed deposit, let's say I have taken for 2 years or a 5-year deposit, what would be the tax treatment? What would I recognize it for my annual?
Okay, when it comes to the interest recognition of a person compared to company is different. When it comes to a company, it's an accrual basis. But when it comes to a person, it depends on the terms and condition of the instrument. Whether if he is going to recognize the interest income on monthly basis or daily basis, it will happen like that. But if you say if you have an instrument for 2 years or 5 years, but interest will be actually earned at the maturity, then on the maturity date, where it fall into which financial year, it will be totally taxed. So that's a one sort of there is a small problem related to the people who have been having this kind of a larger tenure period instruments. Some people's tenure will end up at this March or even up these years.
Yeah.
So then the impact on if it is after March, the impact will be high, because there is now computation guidelines has been already given for the year of 2019-20, because they have taken 9 months and 3 months. So you can actually, they have given 2 options. Either you can go on actual basis, either you can go on pro rata basis. It means 75%, 25%.
Yeah.
So if you really take, if it is a 5-year plan and 2-year plan, so if you really look into it, 75% and 25% only for 3 months, will be a huge amount out of 2 year interest gap.
So that actually, so that 25% will be high and it will be taxed on and can go up to 18%. Depends on the value.
Depends on the value.
Depends on the value. So there is a tricky thing that there is a problem when you go with the largest type and instruments because of this, because we don't have constant tax policy now. When the government needs money, they change the tax system. So because of that, most of the instrument will be get affected. So that's why most of the people go with the very short period of time are looking at the will be a tax. But the problem is when you get a good return, you do not want to
Use the opportunity.
use the opportunity as well. No?
Yes.
So there is an issue like that.
Right.
There's a genuine issue, but can't help. Will be ending up paying taxes.
Uh, Mr. Rodrigo, again on the same lines, let's say there is a husband and wife.
Yeah.
So let's say for myself and my wife, if we invest in a deposit as a joint holders, how is the tax treatment for that? Because that has been a big concern with our clients, and some of them hold their accounts jointly, naturally for given reasons. So how do you recognize that on your individual tax?
So actually, guidelines provided, we normally go on 50-50 basis. So that's how we normally do our customers as well. It has been the practice, and even the IRD knows it, and they have been accepting that practice as well. If you have any in that instrument saying that husband is this much, wife is this much, yes, clearly you can segregate. But if you don't have that kind of a guideline related to the instrument, so you have to go on 50-50. So anyway, the husband wife will be trusting.
Most certainly. So again, if you have invested in your children, is that tax deductible by any chance as an investment for their children?
Okay, good question. Very good question. And so we were having this conversation with IRD as well. Actually, personally, even WRO company and chartered accounts were giving our views as well to the secretary division of the IRD regarding, because still it is under discussion. Still, it is under discussion. IRD, because they need to come up with a solution before the 15th of August, because the first quarter will be ending up by June 30th, and the first quarter payment needs to be made by 15th of August. So now, problem says most of the parents has invested their money in the fixed deposit on the children name. Problem is the children is a minor. He is not in a age limit, which is 18. Going to be adult, then he is a legitimate person. So minor can't make any decision likewise. We have understanding like that. So the problem is they can't open up files since it is not a legitimate person. It's a minor. So there will be those sort of discussions going on that okay, there might, but this only a discussion and such at the date that will be coupled up with the parent personal file likewise. But earlier those days, we used to couple the children's fixed deposit under the parents' file. Later, it was taken out. So now it coming back again. So I can't give you a sort of a direct final answer since it is still under the discussions. And this is actually, and there's another scenario that when it comes to if there is an child who needs special care, and that particular parent and he invested some money in a fixed deposit, that intention with the intention that if the parent passed away, that income is so mainstream will come back to that child who needs special care. That what is going to happen, and that's child who needs special care is an adult. It means he is a legitimate person. Only problem is that whether he is in the right mental capacity to make a decision. That's the problem. So because of that, there is an but at the moment, even the provisions of the Act provide, especially provision, if I say 146 in the section, you can have a representative. It can be a guardian, it can be your parent. So even that return that it allows to sign by your representative. See, it is there. So now itself, actually, the problem is, okay, if the parents are there, they can do that income tax filing for him. He's an adult. In legal term, he needs to pay income tax. The problem is what will happen. Even now they are discussing problem. What will happen if that unfortunately the parents passed away? If the child is alone now, so we were actually providing sort of a guidelines, or just a sort of overviews with the department. Even now we are putting a paper next week as well. Department see what proposing to have a sort of a use of trust ordinance to create of trust, and then you through the trust you can manage the your portfolio, and end of that day the trust will make the payment tax payment to the department. So at the end of the day, the child actually the department will collect the tax, and at the same time the child will reserve his rights to the portfolio as well to the trust. So he will get in the continuous help from the trust in order to make his
So, Mr. Rodrigo, what we can understand, let's say there's a disabled child, it's in a family, you're lobbying at the moment for a form of a trust to operate through a form of a trust.
So the trust, but it will be more beneficial other than that, because after if the parents passed away, what will happen to that child? So we need to take it up when we are collecting the tax. We need to look at the social life aspect as well. That we need to protect that child at the same time when we are collecting taxes. So while we were putting that proposal, so we'll see what will happen. I think yes, they will take a best decision.
Mr. Rodrigo, moving on from that again, if we look at government security investments and FDs, formally under the formal tax regime, your government security returns were taxed on your tax bracket, but if these had a 5% clean tax. But now is there an advantage between the two?
No, both are same.
So all asset class.
But if you have any interest income related to sovereign bonds in dollar terms and Sri Lanka development bonds
Yes.
in dollars, it is exempt.
Okay. So your foreign currency deposits plus your SLBB or Sri Lanka development bonds, inclusive all bonds, will be exempted.
I need to double check with the foreign currency deposit your individual, but I'm really clear on the sovereign bonds in US dollars. Sri Lanka.
So I push a little bit more questions. We've got since we have a little bit more time, Mr. Rodrigo. So there has been a question: is EPF and ETF interest subject to tax?
No. Under that housing, pension scheme, if you're asking if the EPF, ETF is there, no, it is not.
Right. They've also asked, is investment made, I beg your pardon, is medical expenses for family members tax deductible?
Well, we are putting a medical insurance, we are covering up the family as well. So if the government is allowing the premium to be claimed, then expenses for your family also can be claimed. But still, please keep in your mind, still this definition has been not properly defined by by the department. They still need to submit a guideline. So things will change
in the future. So, Mr. Rodrigo, I think that covers a lot, and we are also running up to the stipulated time. I would like to thank you very much for joining us today, and I'm sure some of our relationship managers could route you through to any further questions, or if they need any consultation on. So that could be.
Yes, definitely. I'm happy to help.
Thank you. And I'd love to thank you everybody who's joined in, and I hope this was informative. Again, if you have any questions, please get in touch with Mr. Rodrigo through your RM. Thank you, and have a